we'll be talking again to Hovnanian CEO Ara Hovnanian. Also, John Sylvia, the chief economist at Wells Fargo, will weigh in with his reaction on the report. Plus, we've got team coverage from markets reporter Dominic Chu with the instant market reaction. Economics editor Mike McKee will give his real deal take. And chief Washington correspondent Peter Cook, who is at the Labor Department, is waiting in seconds to bring us those numbers. Remember, 163,000 jobs expected in the month of May. Peter?
175,000 jobs in the month of May, Betty, just above expectations. The unemployment rate, though, does tick up slightly to 7.6%. Very modest revisions, a net loss of 12,000 jobs for the prior 2 months. This report very consistent with what we've seen over the past few months. Let me walk you through it. Again, the 175,000 jobs added in the month of May. Our 6-month average now, 194,000 jobs. The 12-month average, 172,000 jobs. The unemployment rate up to 7.6%. Why did it move up? Well, we had the total number of employed up 319,000, but the total number of unemployed up as well by 101,000. The participation rate also ticking up slightly to 63.4%. Long-term unemployed at 4.4 million. That's unchanged. 37.3% of the unemployed population. Who was hiring last month? Professional and business services up pretty significantly, up 57,000. Temporary jobs accounting for 26,000 of that. Leisure and hospitality up 43,000. A lot of people getting hired at bars and restaurants, apparently. Retail up 28,000. In terms of who's firing, manufacturing down 8,000 in the month of May. And we had revisions to the prior 2 months. We have lost jobs in the manufacturing sector for 3 straight months. Transportation and warehousing down 4,000. Government off 3,000. Federal jobs down 14,000, about 9,400 of that true federal jobs as opposed to including the Postal Service. Average hourly earnings unchanged month over month. The year-over-year increase up 2%. Average weekly hours 34.5, also unchanged. Betty, bottom line, again, a report pretty consistent with what we've seen over the last few months. Not a blockbuster, but not a report suggesting the economy is grinding to a halt.
That's right. Not too hot and not too cold. And Dom, what was interesting, though, is that you did see a little bit of a spike in futures. So investors, traders liking this number.
Well, they are. And we were up about 3 points going into the number. Now we're up about 6, 7 points here. Dow Jones up about 50. NASDAQ up about 10 points. We are just off session highs. But what's interesting is in the 3 or 4 minutes ahead of that number, we already saw traders jockeying for a little bit of an upside surprise. They bid up futures about 3 or 4 points going into the number and then another few points on top of that. So we saw a little bit of hedging for the upside even before that number came out. On the Treasury side of the equation, we are seeing a move here as well. Yields ticking higher, selling off the safety of some of those Treasuries. 2.09% the last trade for 10-year U.S. government notes. On the currency side of things, $1.3241 for euro. And on the commodity side, we'll finish off on crude 95.12 there. Gold futures, Betty, 14.04 the last trade there.
Okay, thank you, Dom. I know you're going to stand by with me as you're watching the markets carefully. But, Mike, the real deal on these job numbers.
Well, it's about as mediocre, lukewarm, acceptable report as you can get. Most of the numbers come straight down the middle. As Peter was reporting the jump in the unemployment rate, not bad news because, of course, more people came into the labor force. Let me just pick out a couple of points here. One bad news and then some good news that is buried in the report here. First of all, the labor force participation rate rises. That's a little bit better news. More people coming into the labor force. We wanted to see that. And then you look at average weekly hours. This is a bit of a surprise. We saw average weekly hours rise, and that may be because of the way federal furloughs were accounted for. And I'll tell you what I mean here. Government jobs fell by 14,000. Local government jobs, we were looking for a decline there. They actually rose. It may be all at the federal level, and it may be that if you were furloughed, you weren't counted as on the payroll. That did not depress average weekly hours, and so average hourly earnings rise on the month. So all in all, not a bad report at all. Leaves us about where we had been, treading water, not really gaining a lot of ground. It certainly doesn't make the case for tapering, though, Betty.
It does not. And that last point, Mike, is maybe one of the reasons why you are seeing a slight rally in the equity markets. I want to bring in now Ara Hovnanian, who is standing by, the CEO, as we mentioned, of the home builder Hovnanian. Also, John Sylvia from Wells Fargo Securities joining us, Dom, and also Mike. But, John, you had a number of 136,000, so you were a bit more on the bearish side. This is even So this is way above what you forecast.
Yeah, it's stronger than what you forecast. And I like Peter's point that basically this number is consistent with slower growth in the second quarter, and we are seeing a number weaker than the 3-month moving average. It was disappointing to notice that manufacturing had weakened. That is consistent with the ISM surveys that we got, plus the regional surveys. So that was there. The federal government losing jobs, not a surprise there. But picking up on the average weekly hours, notice once again leisure and hospitality and retail, those hours did not rebound, and so there is some impact there, I think, from the Affordable Care Act, where there is some cutback in part-time workers.
So to you, there are some warning signs here, John, that tell you that perhaps we may see some more weakness going forward. John?
Yes?
Oh, okay. I was directing that question.
I thought you were talking to someone else.
No, I was directing that question to you. You see what I was saying was that the points that you were making tell you that there's room for a continued bearish scenario on jobs.
Well, bearish in the sense that I think that, when you look at the 220,000 average, 3-month moving average in the prior months, I think we're slowing down. Not bearish in the sense of, really more difficult times going forward, but the economy in the second half probably picks up a little bit, but we are still in that zone of maybe 150, 200,000 jobs on average per month for the rest of the year.
Ara, when you hear that, what do you think about your own business?
Well, I think that's good news from my perspective. Obviously, very positive job growth overall, and I'd prefer a gradual, steady improvement over a rapid decline or a rapid increase. I think it's a good environment. I think too rapid of an increase would create a little chaos and would cause a later correction, a little bubble, if you will, as we were discussing before. So I think steady progress is far better.
What about your own hiring plans?
We have hired, we went from a trough of about 1,400 people to about 1,700 people just in the last year and a half. So we have been hiring both directly and, more importantly, indirectly, the plumbers, electricians, the carpenters all over the country.
Sort of that halo economy or the halo jobs effect.
We have a huge ripple effect in the economy.
And Betty, let me just weigh in on what's going on in construction in the month. Up 7,000 in the month, so again providing support to the economy. We did see a loss the prior month of 2,000, but construction consistently, you look over the last couple of months, positive for sure, certainly providing a boost for the economy right now.
Right, construction jobs, and that goes right into Ara's business, of course. And Ara, a lot of people say, though, that the Fed interest rate hikes, that could eventually be a big damper for the housing market. Do you expect that when that happens eventually, when the Fed starts to taper, is that going to really hit the housing market?
No, I think well, first of all, my late father founded the company over 50 years ago. We've been through a lot of interest rate environments, a lot of ups and downs in the housing cycles. In the early 1980s, mortgage rates in the recovery were in the low teens, 12%, 13%, 14%, and we had more housing starts than we do right now, by almost double. So that doesn't trouble me. What will change is that today, thanks to the Fed helping lower rates, people can buy a bigger house than they ever dreamed, a 3,000, 4,000 square foot house. They will still need shelter ultimately because housing demand is driven by population growth. It may change from a 4,000-foot house to a 3,000 to a 2,500 foot house or maybe a townhouse.
Right.
But they will need shelter and housing will still need to be built.
Well, John, chime in on that, on the housing market. Is what Ara describing in terms of the reaction when we finally do see some tightening in lending rates, is it going to be worse off than we might actually expect?
No, I don't think so. I think you got it right. At the beginning, as rates rise modestly, home price appreciation still exceeds the increase in the mortgage rate. So I would suspect that a modest increase in interest rates will not be